All right. Good morning, everybody. Things are a little bit mixed out there. Green in a lot of the indexes, but not by very much. China's down the most, but only at 0.5%. And we're trying to turn the corner, it looks like. Maybe balance a little bit before coming back up. There's new bricks in the wall of worry. The government shutdown now has an 80% chance of actually coming to pass. Now that we no longer have a functioning government, the situation on that end looks pretty untenable at the moment. We're going to get continuing jobs data today, or continuation of jobs data, say it that way. So we're going to get ADP employment, and we also have ISM services. Another Fed speaker. We're going to have Bowman speaking at a banking conference. That one's not necessarily expected to be all that impactful, but the risk is when any of those Fed speakers are talking that they say something out of turn that they didn't mean to say, and or that it was taken in a way that it wasn't meant to be taken. So there is always a risk when a Fed speaker is out chipping teeth. And then Goolsby, but again, that one, I mean, really shouldn't have any impact in the market. We can see the ADP has a high percent chance of being impactful. So it's one of those that you really want to watch out for. And ISM services is another one, right? So we have European Central Bank Christine Lagarde speaking today as well. That's another potential fireball. So there's 3 separate events today that have high impact probability. And then there's just the normal run-of-the-mill stuff. We also are going to get crude data today, so you can keep your eye on USO at around 10:30. All eyes are on the strategic petroleum reserves. There's been some activity in the 10-year around the world. A lot of discussion about Germany's 10-year that has changed more than 50%. That's 50 in the last couple of weeks, I believe it was. So things are getting a little out of control. We're seeing record levels of things that haven't been hit since the 2007, 2008 financial crisis. It's going to be a busy day all the way around. Still got a China holiday, so we'll have a lower volume. So if we take a look at energy, we're backing off that 94 level. This is WTI crude. Things were certainly higher in 2022. We kind of bottomed out around mid-year. And we're working our way back up that 94 or 93.5. It's kind of a line in the sand for this little basing cup that we have down here. But it's worth keeping an eye on this. When we continue to think about things that are going to impact the Dixie, right, the DXY, this will have some tell to it, right? So keeping an eye on this, watching what's going on in the DXY. Yesterday, it really looked like Japan tried to run an intervention by themselves, and it didn't stick, but they tried. You can see this drastic change in US dollar Japan. Last year, if you've heard me talk about it before, that they did it by themselves and then they did it globally. In October, they did it with assistance from other central banks around the world, and they had success. So the first time they tried it in September, it didn't work. It didn't stick. It's the same thing that we had happen yesterday. They gave it a shot. It didn't stick. The expectation is that they're going to give it a little time and try it again. Especially if they'll try it again if we get to creeping back up to those 150, 151 area. This is Japan's 10-year. It's off the high now, but it had reached 0.8. So it kind of backed off a little bit, but yeah, things are just getting untenable, right? And for that trade, the FXY to the upside, it has begun. Just keep in mind that with that intervention that didn't stick, this is very likely going to fade back. But the move will come, right? If their intervention follows through and US dollar Japan does begin bleeding off to the downside, this is going to make that move up. Just one step at a time. Get above the 20, get above the 50, get through that 65 zone, just one step at a time. So what I'm marking out here is think of the yields, only instead of looking at the TNX and the 20-year, we're looking at the 5-year, looking at some of them front end yields. We're getting into levels that we haven't seen since 07 and 08. So you know, it's unsustainable levels. So here's 06 and here's 07 into 08. The idea is they keep pushing against the front end, like these 2 years, that it lifts the back end like the 20-year and the 30-year. And here's the 30-year bonds, ZB, with that breakdown into that 111. And here's the 08 level that we were talking about. So it's getting pretty nasty out there. The reason I bring all this up is because we're having a lot of volatility in our market right now. The intraday day trades in the futures, and we've got just a whole lot more futures traders than we had before these micros came along. And it seems like every week we're getting more and more new traders into the futures. And if you weren't trading during the last big volatility event, then this kind of volatility is a little tricky for you. So one of the things that you really want to focus on a day-to-day basis is, should I be trading today? You know, for anybody who's been around for a while, you already know the answer to that. And it might sound like a pretty silly question to ask, but you know, if your account isn't very big and you've got to run pretty tight stops, that kind of volatility is just going to run you over. So looking at the weekly here on the ES, we are interacting with that 50-week moving average. If we were to bring up technical analysis textbooks, this low pivot and then this lower high, that sets the trigger. And then breaking this lower pivot triggered the trade, right? So one kind of gets the alert, the other one follows through. So the short trade is in play. The way it normally maps out is, once you get this trigger and you get the first move, then it pulls back again, usually to that low, before it makes the next trip down and or it gets back above that zone. So it's just a step-by-step process, right? That Japan intervention, by the way, will take this back to the upside. But since it failed, like we mentioned, that's off the table until we see US dollar Japan get back into that 150, 151 area. So we do have some elevated volumes this morning. We're sitting above 200. Shows that participation that's been coming in through the overnight, and we've got this megaphone pattern. We did get a nice turnaround through the kill zone, made it back up, and now we're expanding to the upside, but we're not looking for any kind of inside day breakout to the upside here. The range from yesterday is just really big. So while it's possible, there's a lot of work to do. We're now underneath the 200 period as well, both of them. If we mark 50% of yesterday and look for a half back play, it's 42.93, which is a number we've heard many times in the last year and a half. That's a significant pivot, so we keep track of that one. I would like this move better if we had gapped down, but it's all right either way. What we're looking for is one of those days where we make a move to the downside over 2 or 3 days, and then we get that turnaround day, right? That kind of like a 1 week reprieve where we, rip back to the upside 100 and something points. We haven't got the turnaround yet. And even though this is the first green day after these 3 red days, 2 of these red days, we really didn't go anywhere. So they're red, but we were still IX10 at that point. Yesterday is the first day that we really went somewhere, and now we're getting our first green day. So, kind of approach with a little bit of caution, let it earn it. If you're going to try to swing some SPY calls or something like that. The volume is a little concerning. It's a little interesting. We have a lot of things on the table this morning that should keep people at arm's length, waiting on the sidelines before they get into the market. And that's not what we're seeing at all. There's also no market move, so they're not hedging against it. This could either be because the data linked out, right? Somebody already put it out there earlier than they should have, or that there's enough consensus on what the numbers are going to be that they're not hedging against it. I tend to look at that a little bit differently. When they get cocky and they think they've got it all figured out, and nobody's hedging, and we got consensus on the numbers, that's the opportunity to see a train wreck in slow motion. So watch the clock. If they are offsides and the data is not what they thought it was supposed to be, we're going to get some serious violence this morning. (8:15, 9:45, 10 o'clock, 10:30, and then all of those speakers today. 10-day, 30-minute volume profile. We no longer really have an opportunity for the classic B, and now instead we're starting to develop a little bit of a D pattern. As we burn through the day today, we're very likely going to lose all of this volume up here. And what will be left is that D shape. We did bring the point of control down to us nearly by default. All we had to do is lose all the volume from yesterday, and it came down to this 43.22 area. I guess an argument could be made to put on the VPOC, as I normally would say, leave it on there, see if it gets interacted with. And I probably would do that if it had only been this touchback here around 8 o'clock. But we've completely passed through that zone and we're above it. So no VPOC off of yesterday's data. There's no point in carrying that over. It wouldn't belong. It'd be just doesn't fit. We do have a shallow zone. If we can get through this peak here at 42.79, 78, we get into a shallow zone, we should be able to move through that up through the roundy into 43.05 area. So it's a real lack of resistance. So we're continuing to see a move back towards the 10-day. Yesterday got us to the edge of the weekly expected move. We went outside of it. Now we're back inside. We tend to close inside of this box 80% of the time, right? That's the S&P stats. If you take it to any other product, it's 70%. Now I know people, that don't like math. Just count back the last 10 weeks. How many times did we close on Friday outside of that box? If your answer's 3, then you've got 70% of the time you're in the box, 30% you're out of the box. It's just a nice round number. Just count back 10 weeks. Simple enough. So the S&P statistically should close inside the box 8 out of 10 weeks. Once in a while, missing the box, closing outside on a Friday is not a really big deal, but closing consecutively or consistently outside the box again and again, not just 3 times out of 10 or 4 times out of 10, but repeatedly getting out of the box is usually a warning. It's a heads up that market makers aren't accurately depicting the volume, the volatility that's out there, and or traders are just completely outrunning everything, right? That the wild swings of volatility within price itself is greater than what had been measured or expected for the week. Just keep in mind the word volatility is another word for movement. And implied is another word for promised. So when you have implied volatility, you have promised movement. So far, we've got a missed daily pivot, but we are making our way back towards that pivot, so I doubt it's going to stay missed. We expanded significantly from the weekly pivot point, so it kind of makes sense that we're reverting back a little bit. This volume this morning is pretty impressive, but when we were looking at the volume profile a little bit ago and the TPO profile too, there really wasn't anything to suggest that it was only this morning. It's been hitting all night. This lower volume gauge might look like it started it, from no volume up, but that's just because it's cumulative starting at midnight and it just starts adding up any volume that we get. So it's not reflecting any of the volume that happened before midnight. You can really see the intervention yesterday. Even in the market breadth between the advancing and declining issues, like they gave it a good shot. And the algos responded really nice, but it just didn't stick. So as you can imagine, if they did that by themselves, if they do get some assistance globally, the follow through or the outcome is fantastic. That one back in October, we moved so fast in an hour to an hour and a half. So it's worth keeping an eye on US dollar Japan for that intervention again. It's very unlikely that it's going to happen so fast back to back with the last intervention. It took them from September to October last time before they came in and tried it again. So Bitcoin's up, nat gas, bonds, and that's really about it. Everything else isn't up enough to hit our criteria. Thought maybe there'd be some pot stocks in there too, but nope. It seems like we're getting a little bit out of the semiconductors too. So SMH is up. GDX, gold and gold miners are close to being at that level. Things like Riot, Mara, or coin, either one of those three. MSTR fits in that list, but it's not getting any flow yet. Pot stocks really aren't picking anything up yet. Tilray's got earnings on deck, so got to kind of approach that one with caution. So we are seeing a reciprocation in the fangs. They look a lot like the indexes do. That's not a surprise, but at this point, we don't want to take anything for granted. We're going to keep our eye on the fang names today. If we're going to get that rising tide, it's got to start somewhere. I would look for that juncture between those fangs and the indexes to kind of give us a helping hand. So this fade down in the 10-year, that's a good start. The move up in bonds too. So we've got, stocks and bonds moving in the same direction. The Dixie is down a little bit, so that's helping. And we've got crude down, and that's helping. But it doesn't take much for any of these lower charts to find support, begin moving back up. So if we start to see the DXY, the 10-year US dollar Japan begin making moves back to the upside, then we're going to really need to keep our eye on bonds, crude, and stocks to make sure we don't start seeing moves back down again. It's not going to take much for one of these speakers to say something out of line and really just whip this market. So, really approach with caution. And there's no turnaround yet. If you're looking for reasons to, buy some calls and run the market to the upside for like a swing trade, 21-day, 30-day, we don't have anything yet. Even a mean reversion play where we get, like back here in August, I love these kind of days. We close down, we open even more down, like a gap down into a key level, a key resistance, or a key support, depending on which direction you're going. And then we get that rally day and kind of a follow through. We're not there yet. We don't even have anything showing up. And as odd as it sounds, seeing things trying to make that move up this morning, Apple, Google, Microsoft, all trying to push up off of the lows, even the indexes like the NASDAQ and the S&P off of those lows. It kind of takes that idea that we could get that turnaround and sets it back another day. We need the big gap down kind of capitulation flushing trip to offer the liquidity for them to run it back up again. So if we're already beginning to make our move back up and we haven't gapped down, we didn't get any capitulation play, then it puts this run back up into question, right? And we could end up with more of, say, like what we got back here, even just a few days ago, where we had that big down day and we had a minor flip, just a 1-2 day move that didn't stick, right? We talk about measuring candles all the time. The line in the sand was the big candle, the big day. And sure, you know, it got to the 50%, but couldn't get a close above it. Kind of hard to see in orange, but there's the 50. So, you know, that was the line that we couldn't get through. Now, yesterday's candle is the candle that we need to measure. $42.93, right? That's the line in the sand that we need to get through and get a close above to even begin considering an idea that we might turn around and, you know, get some kind of move to the upside. And we're a long ways off from any sort of TRB setup. So we got nothing. I'm looking at the gap list. We don't really have much on that either, you know, for say like pre-market movers and gap plays. Yeah, we got there's nothing here. All right, guys. That's it. Be careful, be safe, watch the clock, and watch the news. This is one of those days. Finance Juice will be your best bet, right? It's a news aggregate service. They're timely, and they have that count strike on there, or whatever that tick strike. So even with the free version, just turn that thing up, turn the audio on. You'll hear it when flows start to pick up. I love it. I use it all the time. Probably should just get the paid version. See y'all tomorrow.